Hello everyone, welcome to this summer 2026 edition of Perspective. My name is Eric Morin. So we're really constructive for the global outlook over the course of the next 12 months. We maintain our tactical recommendation of a slight overweight equities versus bonds. We are constructive for several reasons. First, we do expect global growth to improve and to go back above 3%, which is near potential in the next 12 months. This outlook is underpinned by a few factors. First, we do have the presence of a strong and elastic demand for private investment for tech and also for military spending. And this is something that should keep growth resilient. Also, we do expect oil prices to decline by about $20 to about $70 for Brent in the next 12 months. This is something that will provide a relief to oil importers such as Europe or Japan. So this is something that will contribute to a growth improvement. Underpinning the oil view, we have two assumptions. The first one is that there's a shaky ceasefire that remains in place. There is no resolution, but limited escalation. And we do expect oil shipments to flow through the Strait of Hormuz. And also we do expect the buildup of alternative oil shipping routes to increase the global demand. So net, we do see some sort of a rebalancing or renormalization of supply in the next few months. This is something that will bring downside pressure to oil prices from current levels. Last but not least, we do see limited tightening by the Fed. This is our baseline scenario. First, there is the view that growth in the US will remain solid, in fact, above consensus, but will decelerate in the first half of 2027. And this is something that will allow the Fed to hike by only 25 basis points over the course of the next 12 months. The other reason why we don't expect the Fed to hike by more than 25 basis points is the view that headline inflation will decline on a year-over-year basis towards 2%. So all of this to say the Fed is going to hike, but it's not going to be strong enough to derail the performance of risk assets. Our outlook is for 25 basis points. So the key takeaway for investors is to remain slightly overweight equities versus bonds relative to a strategic asset allocation. This is because we believe the global macro landscape will remain constructive for stocks and risk assets in general. For the full Perspectives report, please consult the CIBC Global Asset Management Insights Hub.